Hello guys and girls, welcome to episode 6. So this is where we get into choosing a broker. This is also very important, and it's key to understand that when you're choosing a broker, it's going to be completely different from where you live. You could be in the US, you could be in Australia, in the UK, etc. So we will never recommend you a broker, but we will teach you how you can actually choose one. So let's get into this episode. So welcome to episode 6, guys and girls. So this is when we talk about choosing a broker. Really important to understand that when choosing a broker, it's something that you should do research into yourself. We're personally not affiliated with any brokers. We never will be. And I think it's really important that you take the responsibility to choose a broker yourself. You know, no one's going to tell you which bank to bank with. Do your research. There's ones that we use, myself use, that I can recommend, but I think it's really important. Whatever country you're in, it's going to be slightly different. So this is a relatively quick episode, so we'll just run this through with you. And if you ever feel that you need any help, depending on what country you're in, of course, feel free to reach out into the community, drop a message in Slack, and people will be happy to let you know with their experiences of who they've been using. So firstly, what is a broker for those of you that just started off in Forex? A broker is essentially the third party that executes your positions within the market. You register, you open an account, which I'll show you, with your broker, analyze the charts utilizing TradingView, and then you execute your position with your broker on that analysis. Most brokers will provide you with resourceful support staff that will help you with any questions, any concerns that you might have on opening an account. And if there is any other issue with the trades executed, you may reach out to the support. Always do your research before choosing a broker and make sure it's a good fit for you and the country that you reside in. Now let's get into fees. So with the fees, a spread is a small fee that the broker will take from you from executing the position with them. It's usually very minor and it's hardly noticeable when considering the outcome of a profitable trade. It's a very small fee. There are a few other small fees to be aware of when reviewing your trading statement or history with your broker. For example, if you're holding positions over an extended period of time, there's a possibility for something called a roll charge on the position for the broker holding the open trade. Now, these fees, again, they're just very minor and they may be viewed as the cost of doing business, and it does not affect your edge in the slightest or affect our reward in any way, shape or form. Now let's moving on to opening a demo account. At the end of this episode, I'm going to show you how to choose a broker in terms of what you would go to, where you would set it up, and a few other things on some orders as well. So opening a demo account. Opening a demo account is one of the first major steps that you can make in kicking your journey, right? Because where we kickstart this, it's easy to, flirt with the idea of learning and things like that. But when you start to open up your account, you start to take it more serious. It's the first time you will get a sense of what it's like to analyze, execute, and manage positions within the market. The one key factor that separates demo trading from live trading is the emotional aspect of trading real capital, which is why we don't stay in it for too long. Demo trading gives us the opportunity to experience, to work out the kinks, learn the strategy in real time, and just learn how to just place positions essentially and use the software. It's important to make the transition from demo to live as soon as you're comfortable. The emotional aspect is something you need to familiarize yourself with as soon as possible, so then you can experience the full effect of risking your own money. That is the most important thing. So that is opening a demo account. What about going live? When should you go live? Well, firstly, opening a live account is the next major step towards getting set up and learning the ins and outs of the FX market. You'll begin to feel the emotions of trading as you scale your account up, which this helps you to refine your skill set and shift your focus towards working on the psychological side as well as the technical side of learning. As a community, Falcon indulges in lessons on mindset and daily habitual routines that can help you manage those emotions and stick purely to your analysis and the execution of the strategy. We will cover what some of these emotions might be in later lessons within the course titled Psychology in episode 9. It really breaks this down into more detail. But what about depositing and withdrawing? When should we do that? Well, it's different for everybody. There's usually a minimum deposit that is required upon opening a live account with your broker. This varies between different brokers, but generally it's nothing too large. Depositing capital into your account can be done with credit, debit, or through a bank wire. With some brokers like Oanda, you can utilize PayPal. Withdrawing capital from your account shouldn't be a priority when you're beginning your trading journey, as you want to be focusing on compounding your capital. However, if you require taking a withdrawal, it can be done through the medium in which you originally made your deposit. So you do it the same way that you essentially placed the deposit of your capital. We recommend that you let your capital compound. As the power of compound interest begins to take effect, you'll reach a stage where your trading income surpasses your living expenses and your account scales. You can then begin to withdraw that capital while still learning the compound effect of consistent trading percentages. Remember, it's really, really good to do things like setting certain rewards. So rather than taking every single month, remember, if you're working for a job, a 9 to 5, what happens? You get paid every month. It's the same mentality, which is why we look on things like quarterly. It's why we measure ourselves on a quarterly basis. It's the same with withdrawing. Withdrawing a certain amount of a percentage every single quarter is a great way for you to think long term and actually experience the real money, because it's one thing letting it compound, but it's also another thing actually experiencing taking money out of the market as well. So even if it's small, it's important to do that in your journey. But of course, compounding your account is the most important, but you've still got to feel those emotions. So now let's take a look at order types. There are two main types of orders that you can choose when placing a trade through a broker. We have the market order and the entry order. A market order will enter the market at the current price. So as soon as you execute the order, the position is live right there where price actually is. This is not a popular one. An entry order, on the other hand, is the most likely called a stop order. So not to be confused with a stop loss, of course. It's placed and is designed in an area in which that you wish to enter that trade. We use stop orders / entry orders, what we call them, frequently in our strategy. As you'll learn more about Falcon, you will see the benefits that they offer in our trading. They allow us to ensure that price has already gained some momentum in the direction before we're actually triggered into this trade. And that really is the most important thing. And I'll show you that on the charts, why we utilize entry orders over market orders. So now let's move on to reliable brokers. So as we said, we're not affiliated with any brokers. We can only talk about the ones that we've worked with, and depending on what country you're in, it may not even be relevant. So this is why you need to do your own research and reach out to people in the community from where you're from in the world. So choosing a broker really depends on the individual and what your preference is. Brokers are the medium in which that you execute and manage your trades. They input your orders into the market after you've placed them. They will execute your positions when price reaches the level where your order was set, whether that be an entry or a stop loss. Brokers make their money through a variety of small fees that we covered previously. Think of trading like a business. There are all sorts of operating costs, but they are accepted because the profits greatly outweigh the expenses. The fees vary between brokers, and this is why it becomes a personal decision to choose which one better suits you. Some of the most popular brokers are FXCM, Oanda, and Saxo Bank, and there's lots of other ones. Interactive Brokers, CMC. There's so many brokers that you can look at, and it will be different in each country. So definitely do your research and reach out to people in the community. But what I want to do now is take you through a few things that I've shown you today and show you about where we would look to open an account, and then go over a little bit more about stop orders and entry orders and why we utilize them and how important they really are. So let's look at that now. Right guys, so when it comes to choosing a broker, this is a common question when you're going to get involved in trading. So I'm just going to show you a couple here that a lot of people use in the community, myself included. We're not affiliated with any brokers, so you can literally choose whatever broker that you like, and it's going to be different from country to country. But essentially, if you're starting off for the first time and you don't already have an account, then you want to start off and get a demo account to just test, get used to the platform essentially. You don't want to be on demo account for too long because you do build up bad habits. It's really there just for you to understand the platform. Then you want to start trading with real capital as soon as possible, even if it is a smaller amount, so you can get real emotions involved. So here we have two. We've got Oanda and FXCM, so I'll just show you that in a second. And literally really simple, try a demo, fill out your details, you'll get your account, and then any further questions that you have in terms of the software, it's really self-explanatory, really easy to use. You can always ring the broker direct and they'll be happy to assist you, or you can just reach out to any of us in the community. Any students will be happy to help. Just leverage the community. We're here to answer any questions, so this should be a very easy process for you. So fill it out, you get your details, and then you're ready to start experimenting with the software. And then you can essentially just decide, you may want to do 2 demo accounts first to see which one that you prefer and what you like the look of. It doesn't have to be FXCM or Oanda, it could be something else. So here we have FXCM. So again, try a demo. You can just utilize that, open your account, and again, ask anybody in the community if you do need any help. Once you've got that up and running, you can start actually experimenting with trades. And with that being said, guys and girls, let's actually take a look at the 2 order types once you've got your account set up, so you can actually understand how we get into the markets and what kind of order types to use, and then you can compare them to risk entries, reduced risk, so you can understand why we would use these type of entries. So let's take a look at that now on the charts. Right guys, so now let's take a look at two types of orders that we utilize within the community, but one that we don't really utilize that much, and it's not popular, but it's important that you understand it. So we have our market order and we have our entry order. Well, let's take a look at CAD Yen and see where we would utilize those. So what does that mean? Well, CAD Yen, we're looking for a sell setup at this top of this structure. As you can see, we broke just above, and we're looking at this trade to the downside. Now, when we go to the 1 hour chart, we take a look at this familiar structure. Let's remove the ray, and let's say, for example, we're looking for this trade to the downside. What would we want to utilize? Well, a market order is essentially you entering at the current exact price in that moment, triggering you into the market. An entry order is triggering you into the trade on a particular area that you suggest. So let's say, for example, at price, you set your order to trigger you in when you get to this price, so slightly lower than this, then you're going to be triggered into the market once the momentum kicks in. So can you see how it's in line with the reduced risk entry? Because taking a reduced risk, you're setting it a few pips below to trigger you into the market. So you would utilize an entry order to take you into the market, which is less emotional. You're letting the market take you in rather than you deciding, and having more of a systematic approach to it, which is what you want to do. What are the downfalls of taking a market order? Well, it's emotional. It can create a lot of psychological problems, and I'll give you an example. Let's say, for example, you're looking at this on CAD Yen, and you were seeing this price here. So you're feeling like you're going to miss the trade, essentially. So rather than setting an entry order, you see price moves to the downside, like so, and you see this wick here. So at this point, you have to understand that price would have been moving to the downside. Now, if you're watching that live in the market, you're going to be a little bit emotional, thinking, well, I'm going to miss the trade now, so I need to get in. You start placing the entry. So market order, you're in the trade at the current price. It retraces, moves to the upside. Your stop was maybe just above here. You're spiked out for the 1% loss, and then 1 hour later, it drops. So not only do you take the 1% loss because you're in early from emotion and taking a market order, you don't capitalize on the trade that could make you 4, 5, 6, maybe 10%. But if you just put an entry order just a few pips below to trigger you into the market and let the market do its thing, then it takes the emotion out of the market. That is the most important thing when utilizing that. So essentially, really, really simple. We don't want to overcomplicate this, but just understand that if you let the market take you into the trade, it is less emotional. Even if you're right by the screen, we still take entry orders. Why? Because the amount of times that I've taken trades where I've set an entry, for example, like so, set an entry like this, just below here, a few pips below, and I've waited for the trade to, of course, trigger me in from my plan, and then what happens? Something else happens. For example, it pushes up, it creates a larger structure, and then we're up here. Now, someone that took a market order because they had this fear of missing out, again, this comes from just a lack of clarity of understanding. If you knew there were 10 trades on the way down, would you force something just to want to be in the market? Probably not. So let's say you took the market order there, you're in the trade now, it reverses, and then guess what? It goes back to the upside. You're now very emotional from the fact that you took the loss for no reason, and now you probably won't take the next trade that's ready, and then you'll see it play out. So you'll take the loss, and then you'll fear the next trade. Then the amount of times that I've set entry orders where I could have set a market order and be tagged in, and I set an entry order and I didn't, and price would then move back up. I then remove the order, and then I'm able to get in at a better price with, let's say, a double top, and then take the sell. So it's also, on the flip side, it helps in so many other ways, and you're letting the market do its thing. And again, you've back-tested this. So if you're back-testing and you're taking trades on the break, why would you be utilizing market orders? I'm not saying you can't, but it's more emotional that way, as it encourages more of the fear of missing out. You see the market going, you'll end up taking trades before the candles close, because you'll be looking at, right, you'll see the move down, 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 and then you'll see it retrace, and you'll see a wick, and you'll think, how did that person get involved in that trade? The only way he would have, or she would have, is if he was looking at it live and you set a market order, so you got involved as the price was happening because you saw the momentum. So for example, you see price here, by the time that closed, it could have been all the way back up here. So we had a huge wick. And if you got tagged into this, well, the only way would have been if you actually set an entry order, you would have ended up taking a break even possibly, or if you got in at the market order with the momentum because you had the fear, then you'll end up just taking silly losses. So essentially, I would say if you're a beginner, stay away from market orders. You really don't need it. And if you think about the Falcon style, and we look at typical, 6 to 8 hour corrections, and a lot of the times it's a lot more, it doesn't matter whether you're working a 9 to 5 job or not. You've got more than enough time. That's the great thing about the strategy, that you can set your entry orders. Let the market do its thing rather than you deciding that, right, I need to be in the market, so I need to trade. The amount of trades you'll save yourself from just doing that thing, it will be huge for you. So guys and girls, go and test that again. Look at trades where maybe you would have been emotional, maybe taken the trade if it was a market order, or take a look at it from a perspective that actually it's far more sustainable, less emotional to take it on an entry order. And again, if you need any further help with that, feel free to reach out to anyone in the community. Right guys, so now you're set up with your broker, you're fully prepared, you've got your account sorted. Let's get into the next episode where we go into episode 7. This is where we go into more how to track the data, how to backtest, keeping things as simple as possible, and doing things like your ASR, your advanced self-review, which we're just about to get into.